What's going on, traders? Welcome to the channel. My name's John. We trade options here. Today in this video, I'm going to show you how I set up a really quick $500 options income trade, and this is set to expire January 15th, so that's 10 days from now. The trade here is a covered call trade, so for anyone familiar with that, you'll probably know what I'm talking about, but for anyone who isn't, make sure to look it up a little bit further, but I'll give you the basics here. You're going to own 100 shares of stock, and then you're going to sell a call against that stock at a certain strike price and delivery date there, or an expiration date. From there, you're making a bet that the strike price you've set, the stock will not trade above that price by that particular date. The reason I'm a big fan of this trade that I set up is it is in Mara, M-A-R-A. And with Mara, I don't have intention of, being a super bull. I do think crypto is a good play to mess with, but I don't mind this trade. I'm using it primarily for income. So if my shares get called away, fine. If they don't, even better. I'll keep the shares, and I should be pocketing, whatever difference in profits I would make for that options income trade. So to give you some details, I'll put them on the screen here. Basically, I bought 500 shares of Mara at a cost basis of $12.29. Now the difference here is I'm only trading 4 contracts against it. So I only have 4 covered calls, and they're at varying price levels. So, I hope this doesn't make it too confusing for everyone, but to give you an idea, I traded 2 contracts at the $13 strike level, and I traded 2 more contracts at the $14 strike level. And that is, they are all set to expire January 15th, 10 days from now. So here is the upside. On the 2 covered calls at my $13 strike, I pocketed $286 in premium. Again, if we stay below $13, I take all of that. If we do go above this price level, I'll net the difference between the $13 strike level and my $12.29 cost basis. So that's basically a 71-cent difference. If you're multiplying that out by the 2 contracts, that actually makes it $71 times 2 contracts, and that puts me at $142 of profit on this trade for my 200 shares. My next 200 shares that I'm putting at risk as collateral at the $14 strike level, I collected a premium here of $230. So as long as we are underneath that $14 price level by expiration, I'll take all of that $230. If we do end up trading well above the $14 level, my shares will get called away, but I will pocket the difference from that $14 strike level to my $12.29 cost basis, which should bring us to, for the 2 contracts, that would put me at $342 of profit there. And so as I pair the 342 with the 142, that would put me at $484 of profit if my shares get called away. And here's the best part. I'll still be holding on to 100 more shares if Mara keeps taking off. So I didn't quite cap my upside completely on this trade, but I did try to limit some of my downside, but I still have the capability with 100 more shares. And then also, what will happen is I end up lowering my cost basis. So best case scenario, I end up with 500 shares still. We're trading under the $13 price level, and I pocket all of that $516 in premium collected. I have your premium of the day. Hope you're ready for it. And this one came in from Wyatt Ork. Wyatt Ork. One of those. And this is a life pro tip. If your kid is not drinking enough water, sneak something spicy into their food. I hope that was helpful. Make sure to do what Baby Groot says and subscribe. We got great premium value coming to you multiple times a week. All right, thank you. I'll see you on the next one. Bye-bye.